and welcome. I'm Andrew Howard, Chief Investment Officer here at Catholic Super, and I'd like to welcome you to this investment update for the financial year ending 30 June 2024. With the financial year starting off with heightened fears around the risk of a US recession and interest rates remaining higher for longer due to concerns around inflation, it's great to report that we've delivered another year of positive returns to our members, highlighted by the balanced growth option, which returned 9.23% for the financial year. We're very conscious that these strong results have been delivered during a time when inflation has reached levels not experienced for many years. This has resulted in significant cost of living challenges for many people in Australia. So it's pleasing to be able to deliver strong returns for our members that build on the positive long-term performance of the fund, with our balanced growth option returning 8.19% per annum over the 15 years to 30 June 2024. Our purpose is to support our members to prepare for financial freedom in retirement. And so when it comes to growing wealth over the long term, we focus on ensuring our members accumulate wealth in absolute terms. That is, after we account for the impact of inflation. We talk about this as the real return, and you might also have heard it referred to as the inflation-adjusted return. Let's look briefly at why it's important to take real returns into account. Let's say the option you are invested in achieves a return of 5% for the year. But inflation has gone up 3% that year. That means your cost of living has risen by 3%, and this effectively wipes 3% off the true value of your investment return. So your real return, after taking that inflation impact into account, is now 2%. Let's look at how that translates to our balanced growth option. When viewed in terms of the real return, so the investment option return less inflation, the balanced growth investment option has generated a real return of 5.34% per year on average over the past 15 years. And that's given members invested in that option a cumulative return of 118.18% above inflation. Turning our attention back to what we've seen unfold over the past year, after a slow start, we saw a significant turnaround in global shares, led by US markets. Since the lows of October last year, the S&P 500 index is up a staggering 33%. Even more impressive is that these returns have been delivered during a period where expectations for interest rate cuts have been wound back materially. A lot has been said about the rise of the Magnificent Seven, which we've touched on in previous updates. These companies have delivered the bulk of the index returns in the US as the market's fascination with AI continues. This was headlined by the extraordinary rise of Nvidia, which today is one of the largest companies in the world. The strong rise in equity markets was a positive contributor to returns and certainly benefited our higher growth options, with the Growth Plus option returning 12.12% for the financial year. The fund also delivered strong returns for our retirement income members, with the Retirement Income Balanced Growth option returning 9.88% for the financial year. Retirement income members in our higher growth options enjoyed double-digit returns, with our Retirement Income Growth option returning 11.78% for the year, and the Retirement Income Growth Plus option delivering 12.83% for the year. It's certainly been a positive period for investors since the sharp turnaround in markets in late 2023. But we maintain our view that there is potentially more risk to the downside. While the market's infatuation with AI remains buoyant, expectations for earnings growth of these companies seem very optimistic, and there is little room for disappointment. Another key factor has been the underlying resilience of the US economy, which has meant earnings and valuation multiples have remained elevated. In the US, investor sentiment is increasingly favouring the likelihood that the first interest rate cut will occur soon, although exactly how much relief will be delivered remains an open question. The economy is showing some signs of weakness. Manufacturing data, a key barometer of economic activity, is sluggish. The labour market, which has remained very strong for some time now, appears to be at a turning point. As outlined in our previous update, investors' attention will remain focused on trying to determine what the Federal Reserve will do next. In addition, the upcoming US presidential election in November is also becoming a focal point for markets. Investors will be trying to assess what the ramifications might be depending on who is successful. If Trump is elected, his agenda of continued fiscal largesse, lower taxes, higher tariffs and deregulation would likely be inflationary and may make life difficult for the Federal Reserve in its quest to bring inflation back down to targeted levels. Finally, geopolitical risks remain heightened. There's still no end in sight to the war in Ukraine, nor does there appear to be any resolution in sight to the ongoing conflict in the Middle East. All of these factors lead us to believe that while it has certainly been a great year for investors, it's not a time to be complacent. And our focus remains on ensuring that we have an investment strategy in place that's able to navigate through all market environments. If you'd like to find out more information, please head to our website. Thank you for watching.